Good morning, everyone. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion, and I am here with Stephanie Roth, chief economist with Wolf Research. She also did some time over at JP Morgan before moving over to Wolf. Also with us this morning is Karl Smith, previously VP for Federal Policy at the Tax Foundation and assistant professor of economics at the University of North Carolina, also currently my colleague at Bloomberg Opinion. We are here to talk about CPI, which we're expecting to come out in about 4 or 5 minutes now. The street's expectation is that we are going to see a 0.3% month-on-month move on the core, which would be a little bit less of a brisk pace than we saw, somewhat alarmingly to some folks, last month. And so we're going to see what happens, and we're going to see how markets react. I wanted to kick it over to Stephanie with us on the live react for the first time and hear a little bit about what's gone into her forecast.
Sure, happy to be here. So in the January print, we believed much of it was driven by seasonal noise. So much of that surprise, especially in the service sector, was seasonality. They have trouble seasonally adjusting the data, especially after a year of strong inflation, because a lot of prices reset at the beginning of the year. And this is kind of a catch up to last year's still firm level of inflation. So we think that you should have a decent payback in the month of February, and that contributes to our forecast heading into the print of 0.28%. So we think we'll get a slowdown in services, and then there's a lot of funky things that happen under the surface with OER, which we can certainly dive into, and we expect that will be a little bit softer as well.
For sure, for sure. A lot of people really expect that January number was a funky one, but we're gonna see just how funky it really was. Karl, let me ask you to do the sort of big picture step back, if you would. Like, tell us your story about the inflation journey we've been on and where we are at the moment.
Okay. I guess in the really, really big picture, we had, two components of this burst in inflation. And one was, a supply chain component that I think, New York Fed estimates was probably about half of it, at its biggest. And the other was, excess demand that came through from very low interest rates and stimulus, when Biden first came into office. And so I think that, what we saw last year was a really rapid fall off in the component that came from supply side constrictions. Even though the worst of those kind of things had already passed, they were still impacting prices, and we hadn't seen sort of that come off. So that's how we had this almost surprising drop, last year. As we've seen, sort of like the effect of demand, coming through. I think, as most people have noted, it's sort of settled into housing as being the primary component that's still affected by it. And again, this is just because housing is moves so slowly, adjusts so slowly to the sort of extra stimulus and demand. Most of the rest of the demand side of the economy has sort of gotten the boost, and then the boost has gone out. And so our sort of fight here now is how fast will housing, continue to come down versus will we see any sort of return of the supply side prices, maybe because of what's happening in the Red Sea. I think that's kind of the main thing, two things that I think about when it's housing versus shipping.
And of course, we've all been debating for the better part of the past 2 years whether sort of the Bureau of Labor Statistics really measures housing correctly, or if they measure it in the most timely fashion. And of course, the answer that we usually come to is it's complicated, guys. Right? So there are some actual market dynamics, and there are also some measurement dynamics at play here. But I'm going to stop yapping a little bit because the number is going to hit any second here, and we will bring it to you when it populates on my screen. And there you go. you end up getting 0.4% again. And I'll tell you off the bat, the bond market is probably not going to love this, but it matters. It matters tremendously what's going on under the hood. Year on year, that brings our headline number to 3.2%. Which is actually a little bit of an acceleration on a year-on-year basis. And it brings our core year-on-year to 3.8%, sort of the opposite story. It's still, technically a deceleration on a year-on-year basis. But again, looking at the number month on month, I have to believe that the market isn't going to be super pleased with another 0.4%. As you guys are taking that in, let me just take us over to what's going on with the 10-year yield, just to give everybody an idea. And surprise, surprise, we've got. I mean, it's not a huge move. I want to say it was a bigger move last month off the bat, but this is just sort of the knee jerk. You see the 10-year yield move up about 3 basis points, maybe 4 basis points intraday off the bat, and so there you have it. Stephanie, just on a sort of headline basis, the number itself, without having had the opportunity to dig under the hood, like what do you think it means to this market that we're looking at another 0.4% ahead of the Fed meeting next week?
You got a little bit unlucky in a couple things. So you're at 0.36, which is a little bit slower than 0.39.
Okay.
Had you been, a basis point and a half shy of that, you would have rounded down to 0.3. But nonetheless, it was definitely firmer than what we were expecting. Airlines increased nearly 4%, 3.6%. So that was kind of a big pop. On rent inflation, OER actually did come down quite a bit. So the concerns last month that you would have this like sticky rent inflation because it tends to be long lasting, like that's kind of over. So even though, and maybe that's to your point why the bond market maybe is a bit more muted than you might expect, the details are not maybe quite as bad as the headline Bloomberg screen would suggest.
Okay.
There are things that kind of are probably fleeting, things like transportation and airlines kind of driving it. And I would very much expect in March that should probably cool down.
Okay. And airlines, are you suspecting that's coming from dynamics in fuel pricing?
It's probably different than that. Fuel pricing didn't increase enough to drive that kind of increase. My sense is that it's probably seasonal in nature, and then there has been some strong demand for travel, so it might also just be a reflection of actual sort of demand for services and travel in particular.
Okay. And so coming into this today, Stephanie, what had been your expectation for the Fed? When were you expecting them to move?
So base case was that they would be cutting in June. I still think that's a possibility, but perhaps at the margin, this pushes that back to July. I wouldn't necessarily make any bold statements yet on the timing, but I don't think this necessarily means that they can't cut it all this year.
Right.
Oh, yeah.
And so Jay Powell has basically said that we want to see more evidence before we do the first cut, and he likes to do the central banker thing and be predictably vague about what exactly that means. But in his words, sort of paraphrasing here, we want more evidence, not necessarily better evidence. Do you think that a number like this potentially constitutes more evidence, or is this one just kind of like a throwaway, and we have to hope for something better for March?
You're gonna have to hope for something better. This is definitely not more evidence. This is not. If we continue to get prints like this, they're gonna have a hard time cutting. Maybe we'll leave it at that. But this definitely does not constitute evidence that's consistent. Granted, we haven't gotten PPI yet, and we'll get that on Thursday, which is important. Which is a lot of important indicators that go into the PCE number.
For sure. Okay, Karl, any immediate reaction while I put up another screen here to look
Yeah,
at?
I mean, so I think, like I said right before we started, like directionally, this is kind of like, where my concern was, and my analysis on it is a little bit more macro level, and it's simply that the drops that we had at the end of last year were surprisingly large because they were like factors, right? So I think seasonality we're getting the opposite seasonality effect at the end of last year. The goods were coming down like much faster than seemed to be sustainable at the end of last year. And I think actually shelter was moving pretty well. So like it the chances were that all of those sort of like things coming together were going to kind of falter a little bit. I mean, when I was looking at it, I was even worried just if we stop like getting any sort of like negative contribution from goods, that was going to make it, that was going to make things much, much more difficult. And so we didn't even have to see like a bump up in prices. And so I thought people were a little bit like, overly optimistic about, we've done it, we've beaten it. I was like, well, we'll probably have like a little bit of a kick back up, from this, unexpectedly good news. And so in terms of where we are, this is about like what I would have thought or what I would have feared, I guess is a better way to say it.
Okay,
Um,
so I want to jump on something that you just said. Essentially, you and I think a number of other people had noted that core goods deflation was contributing big time to the relatively good run of data that
mhm,
we had, and there was some concern that the story in core goods would become less good, and
mhm,
so. I'm eyeballing this now, and it seems like we might be starting to see some of that.
mhm,
So the decomposition that I have up on my screen right now is telling us that we did see a relatively a big slowdown from January to February in core services
mhm,
contribution, but we now have core goods, at least for this 1 month, contributing positively to the number. This is the contribution. It's only a 0.027, but it had been significantly negative for
mhm.
several months running. Really, November, December, January, and pretty much every month, with the exception of October. So I'll just dig into this a little bit and see if we can figure out what's going on with the core goods story. Uh, so that's interesting. I think we might have found it. Apparel,
Mhm.
a relatively big swing in contribution, ends up going 0.075. Again, that's the contribution. That's not the move in the apparel index itself. That's a pretty meaningful contribution. We also have a pretty meaningful contribution from other goods at 0.049. I'm very interested in this apparel story. I have to say, the Chicago Fed has this tool called CARTS that looks at what's going on in retail sales based on high frequency data, and they also give us a read on inflation. They had sort of flagged that core goods pricing might be a little bit higher this month, at least as of the first half of February. Um, if you look out in the stock market, it seems like demand is pretty good for certain types of apparel. I mean, you had Abercrombie stock acting like Nvidia there, which is a weird kind of sign. Um, but I wonder what you make of this, Stephanie. Do you have any thoughts on the strength in apparel this month?
Yeah, I probably wouldn't make too much of it. I mean, it has been deflating since August of 2023. It ticked up, in the latest print, but I'm not sure I would like make too much of it, other than perhaps that the deflation period of this, among other goods, is perhaps behind us.
Right.
Um, we goods have been detracting by about, if you look at the PCE, which is what the Fed's tracking, it's been detracting 50 basis points about from the sort of recent trend rate. And that's probably not going to be the case going forward. And even Powell said this in the latest FOMC. He said they're expecting kind of goods prices to be flattish going forward rather than deflating as they have been. And I think that's a totally fair assessment. So core goods increased 0.1% month on month, which is, you know, different than where we've been because it had been deflating. And I think it's fair to assume it might be kind of flattish on a go forward basis.
Oh, fair enough. Let's do core services here, which obviously has been a big part of this story. As you can see from the bar chart from January, core services really was the story. January. And as Stephanie pointed out, we see a sort of beneficial reversal to some extent in February. What's going on there? So Stephanie's eagle eye caught this straight away. Shelter, big reversal. The entire shelter basket, which includes the OER, it includes rent of primary residences, it includes lodging away from home, and some other stuff. Basically returns to, you know, its November, December pace. That hot January contribution is out of the system. That's all good. A fair bit of that is what was coming indeed from the reversal of owners' equivalent rent. That huge contribution in January reverses itself. We all got the opportunity to sort of nerd out about this data point over the past month, but I think at this point we can all kind of say it was noise. It was noise. Beyond shelter, we get softer medical care services, which has been a big factor here. Transportation services. I know that Stephanie caught this straight away. A little bit of a hot read, and what's going on under the hood there. You've got a couple things going on. Public transportation, I guess that's the airline fares is up. I did want to just real quickly check on motor vehicle insurance. So that cools a little bit. That has been one that people have been concerned about over the past several months. It's been a big contribution to recent CPI reports, and it's another one of these ones that's kind of a lagging factor because you had auto parts and repair services prices surge over the past couple of years, and little by little you see these auto insurers incorporating that into what they charge you in premium. And so in a sense, the inflation in motor vehicle insurance has been a lagged result of what has gone on in different types of core goods inflation. Stephanie, do you think that we might see some sustainably better prints from the motor vehicle insurance component going forward here?
Yeah, and we should. I mean, even in this month, it was 0.85 compared to, it's been averaging kind of 1.4% for the past couple of months. So it is possible you'll get some volatility in the future, but generally speaking, it's been catching up to the increased prices in terms of used vehicles, and now that we're largely caught up, you should start to see slower prints from here. So generally speaking, slower prints, but it's possible just because you did have such a large deceleration in the month of February, it's possible you'll see a little bit of volatility in the next couple prints, and then eventually headed notably lower.
Yeah, for sure. And so you said that we got unlucky in a few components. I think we've seen some examples of what that is. If you take airline together with the strange behavior in apparel, and you maybe hope for some reversal of that in the months ahead, it's not too hard to get to a more encouraging story for for the next few months. Would you agree?
Yeah, like for example, airlines contributed 9 basis points to core CPI. That's a big one, and it's
Yep.
unlikely to be sustained. So had you not had that, your print would have been, notably lower.
Yeah.
So I think airlines
At
is one of the big
consensus,
ones.
right?
Sorry.
Yeah. At consensus, had it not been for that.
Exactly. So you did get sort of unlucky. And then by the way, used vehicles, which had been declining for quite some time, now actually increased a little bit in the latest, well, 0.5%. That's not even a little bit, but it has been a volatile category. Last month you got unlucky on a lot of things, but you got lucky in used vehicles because used vehicles fell 3.4% in the month of January. So it's probably a bit of just kind of volatility around that. So the combination of some stronger goods on apparel, used vehicles, and then airlines, that those are a number of the categories that are a bit different than maybe folks were expecting, especially those that were looking for 0.3 or slightly below.
For sure. Okay. Karl, you've been writing a lot on the. I see some funkiness going on with my screen. I'm just going to reload that while you're talking, Karl. But you've been writing a lot on the labor market recently. Going back months, there was some sense that the labor market in the United States of America was too hot. There was a lack of balance there, and that it needed to be rebalanced if we were going to see progress in the inflation story. Talk to us, if you could, about the relationship between the labor market and inflation today.
Yeah, so I think my thought over the last couple of months is that the labor market is a lot less hot than it looks. The first trend that I picked up on was the extent to which, or the speed, I guess, at which hours per week was falling. And one of the things that it looked like was that during right after the pandemic, companies had a really hard time finding workers, and so now, and we're in this period where labor, I think honestly, labor demand is going down. You don't see companies shedding as many workers as they would, but just trying to cut back on hours so they don't get into like the shortage position again. And so we had hours for a couple of years being above average. Now I think average hourly week or average weekly hours is slightly below. And so if you take that's cut sort of like the growth and total amount of like work done in America has cut that growth rate in half. So I think it's a little bit weaker than we would have thought. The other thing, and I think we saw some evidence of this, in the report yesterday, is that immigration is probably putting more people into the labor force than we're I guess accounting for. And so that's why we're seeing like the household number, where you just go and interview people about what's happening. It's looking a little weak, unemployment's going up. You're saying, well, what's happening? We're having these strong payroll numbers, but the thing is, the payroll numbers need to be even stronger than we would have thought, because we might be adding like 1 million people or so a year from immigration that we weren't really expecting. And so those two factors together, I think, make us believe that the labor market is not tight. It looks like, if anything, we have more and more companies reporting that they're fully staffed up, maybe a little bit overstaffed, but they're not ready to lay off because they don't want to get caught back in that labor shortage situation. And so anything, I think, that continues to sort of like pull down on demand at all could have some like obviously negative effects in the labor market. Obviously, we already have a move up in unemployment, but that kind of move could continue. And so I think we have a little bit of a fight of re-updating. Inflation is not as perfect as we would have thought, but also the labor market is not nearly as tight as we would have thought. I think, given Powell's personal disposition, the labor market weakness is probably more important. I don't really have a strong sense for how the rest of the FOMC is going to go there, but I think a couple of points here on inflation is not nearly as big as a genuine concern that the labor market might be close to neutral, if not falling lower, would move his opinion more. That's my take.
Okay, fair enough. Stephanie, what about your take here? Are we living in a Phillips curve world? Is the labor market the big risk here?
I agree with Karl. I think immigration is having a big impact on the labor market that's not really being fully measured by the household survey. It's especially with CBO's numbers that came out earlier this year that talked about a sort of a much stronger path for immigration than had been forecasted in most of the other measures like Social Security Administration and census. It suggests that the household survey might legitimately be mismeasuring because their samples are not updated in sort of real time to reflect the changing dynamics on the ground, and it's very possible that's explaining why the two surveys have diverged, where the establishment survey is running significantly hotter than the household survey, and also why the labor force is perhaps being understated. So the combination of those two things suggests that the the break-even level of employment that doesn't tighten or ease the labor market is probably higher than what we historically would say. Like historically, you might estimates would be somewhere between 50 and 100,000, and it's possible that's pushing up now towards closer to 200,000, which is a very different dynamic. So we don't have to be as scared of firm and jobs prints as maybe we thought 6 months ago.
Yeah, there's an interesting trade-off there that like the macro numbers are going to look better because of like the unexpected, immigration in terms of like GDP and sales and stuff like that. But the labor market we should think of as a little bit worse in the sense that it's not as tight as we thought. Like the monthly growth in payrolls is not as spectacular as we thought. So I think there's like an interesting dynamic there. It occurs to me, and I'm just not sure how much this could be affecting it too, is that if there's more immigration coming, that the housing numbers should come down slower than what we're expecting as well, right? Because we're going to, especially in rents, we should see more demand than we had been calculating. I mean, I'm not into the weeds on that kind of stuff, so I don't know exactly how much forecasters, would have put that in. But just as a general readjustment, I'd say, yeah, we should expect, job growth is not as tight or whatever, and that the housing is, I guess, not as bad, or we should expect housing to be coming down slow if we're having like more renters on the ground than we thought.
Yeah, that's fair. Although, I mean, at least we have a lot of supply coming online in terms of multifamily, so that could perhaps help offset that because a lot of folks were concerned that there was going to be too much supply in multifamily, and perhaps maybe that supply is going to be met by this unexpected demand.
For sure. So, listen, as we wind down here, guys, I'd love to hear what your expectations are for the Fed next week. We've got a data-dependent Fed. They haven't gotten great data, at least on the prices side of their mandate. So, what's the most important piece of information you'll be looking for next week, Stephanie, when we get a new summary of economic projections and we hear from Jay Powell at the press conference?
I think perhaps the most interesting thing is going to be their estimates for the dots for this year, because as of now they're expecting 3 cuts, and this will be a real litmus test of did the last 2 inflation prints change the projections for a number of the Fed members, and it's possible that it did. That's something that I think the market is going to be paying amongst the most close attention to. And it's very possible because especially if they move out of the first cut to say July, then perhaps they'll have one less opportunity for a cut this year, and it might look more like 2 cuts. So that's going to be kind of the big debate out there next week. Otherwise, Powell will probably be non-committal in terms of the next cut, perhaps pushing against May because May is incredibly unlikely at this point.
For sure. Karl, if you're sitting in Jay Powell's seat, do you let some weird prints in apparel and airfares dissuade you from cutting in this environment?
Well, see, I think I have a similar disposition of Powell about certain things, which is like about like people getting excited about month to month, and so lots of things happen month to month. I mean, some you can spot, some you can't. Some cancel each other out, and so I'm a steady year-on-year guy. Let me see some year-on-years. Like get in the right direction on that, and so I think the Powell thing to say is, this is what I was afraid of. So that's I want this to keep going, to be sure. What I'd be looking for him to say, though, is whether or not he starts talking about more balanced risks, right? So if the Fed really was going to start to be concerned about the labor market, they want to signal that way out in advance. They don't want to just come up and say, oh, yeah, we were all focused on inflation and like this, but now I actually think that, labor market's a problem, so we're going to do something different. They don't want anything remotely stuck in that. So you start to see little language like, risks have come more into line, like we're seeing a problem. And Powell, especially in the way he talks in the press conference, we'll probably be kind of frank about that. It's like, look, I'm seeing some stuff here, and so I want to know how the labor market is doing now too. And if we see that, I think that's what how I would expect him to react to all the updates that we've seen over the last month or so. And if we do, I think that's good, because I think it probably doesn't reduce the chances of cuts as much as you would be afraid just looking at the inflation stuff. So that's really how he talks about the labor market is probably the tone he has is probably the biggest thing I would look for.
All right. Well, I'd like to leave it right there. Your quick market check before we leave you is the yield on the 10-year is up just a little bit intraday on the back of a slightly hotter than expected 0.4% month-on-month change in your core CPI. I'd like to thank Stephanie Roth, chief economist at Wolf Research, for being with us, as well as my colleague Karl Smith, Bloomberg opinion columnist. I'm Jonathan Levin, and thank you very much for